Okay, I think we are live on YouTube. Also, please forgive me, God did. Yeah, I think we are live on YouTube. Let me come back to Zoom. Got it. Let's go. Okay, so welcome to the first session in our Executive Leadership Masterclass sessions. And the purpose of these sessions is to enable us to solve questions relating to the few things that we have covered so far. We are now heading to week 8. We've covered a lot of things in management accounting. Majority of what we have been doing has been on the introduction to management accounting, spending time on the short-term, issues relating to absorption costing, marginal costing, activity-based costing. So we have a question that we are going to be looking at today. That is the smooth sailing question that, a couple of you tried your hands on, and we're going to be getting into that to see what exactly we can do about that. Then we came to short-term decisions using the marginal costing principle, and we looked at the various short-term decisions, limiting factor analysis, throughput accounting, make or buy, shutdown decision, relevant cost analysis, pricing decision, outsourcing decisions, break-even analysis, a lot of issues in that case. But one of the areas that we also have an outstanding question to solve, which was given as an assignment, is the relevant cost analysis, Mr. Smith. So we're going to start our discussion today with that question, Mr. Smith. And then after that, we will jump into the marginal costing and then absorption costing question, the smooth sailing question as well. Like I said, the purpose of the Executive Leadership Masterclass is to be able to address some of the challenges that you have and to be able to assist you to really understand these fundamental principles so you can position yourself to pass the examination. So stay with me carefully as we go through these and work together. And let's see, hopefully by the close of the day, in the next 2 hours or so, we will be able to, conclusively reach a reasonable, or we can reach a reasonable conclusion that, okay, relevant cost analysis, now you are good. Then marginal costing and absorption costing also, now you are good. Even though in our Executive Leadership Masterclass proper, which is the 2 weeks to the exams, we're going to be solving some questions as well in those topics. But that's what we want to look at today. Any questions for me before maybe I get excited into Smith and the smooth sailing question? Any question for me? Something you want me to share my thought on before I get excited about today's discussion? Or we good? We can jump over. And let me bring my screen up quickly. Yes, Isaac, your hand is up. Isaac, your hand is up. What you got?
Hello, sir. Good evening.
Yeah, good evening.
Yeah, please. My question is on make or buy. And resource. I didn't get this statement well. That resources, when resources are unlimited, then the relevant costs are, that is variable cost and specific fixed cost. I wasn't clear. I was thinking, since the resources are unlimited, meaning you have to what? If they are unlimited, in a way you can make it, right?
Yeah, if we don't have problem with resources, we look at the actual cost we need to incur to produce the product. So that is why we would have to look at the variable cost of producing the product and the specific fixed cost we will incur in relation to producing that product. So if we have unlimited resources, it means we don't have any problem. There is not going to be any opportunity cost because there's not going to be any transfer of resources from one department to the other. So then our headache would just be the marginal cost of production. And in that case, the marginal cost of production will be the variable cost of production plus the specific fixed cost. That is the fixed cost that we will incur if we have to produce that product in-house. Does that make sense? Are you okay with that? Let me know if that makes sense for you. And then any other questions for me? I see some of you guys joining us on YouTube. You are welcome. We are looking at relevance costing, marginal costing, absorption costing. If there are any questions, put it in the chat for us, and we're going to be looking at it as we continue with the discussion. Isaac, I don't know, maybe your network is messing you up. Let me bring up my screen and let's go. Coming up. So we are going to start with Mr. Smith. So you grab your question and let's go. Now, like I say always, you know, if your English is not good, you're going to be screwed under relevance costing. And a couple of you had problem with that particular question, but we're going to see how we can deal with that generally in that case. So let's go. Mr. Smith. Mr. Smith. The requirement of the question is pretty simple. Let's see what we have here. It says, calculate and explain to Mr. Smith what you believe the minimum tender price should be. Now, it's always important to understand what kind of principle am I supposed to apply in a given question. So look at the requirements of this question. It doesn't tell you what you're supposed to apply generally, but it just said, what do you believe to be the minimum tender price? So the clue is that anytime you hear that the examiner says, oh, calculate the minimum price of something, calculate the cost, the minimum cost of something, then quickly it means you would have to apply what? The relevant costing principle. Okay, you would have to apply the relevant costing principles. And beneath the application of the relevant costing principle will be the issue relating to the marginal costing principle ultimately. Okay, will be the issue relating to the marginal costing principle ultimately. So that is why we know that's what we're going to do. So let's go. Put the name up. Mr. Smith. Minimum tender price. Minimum tender price. We're going to shift this into the middle a little bit. And you know the pro forma, how we go about it. Dollars. Going to have the notes here. And we're going to have our notes here because if you remember, the question said you should calculate and explain. The question said you should calculate and explain. So it means that the note is going to be important. And like I tell you all the time, as far as we are doing marginal costing, as far as we are doing relevant costing, even if the examiner doesn't ask you to explain, you will still have to explain how you arrived at the relevant cost. So it is something that by default, it will be done anyways. It will be done anyways. So let's see. Let's go back up and then pick the question. Mr. Smith has been asked to quote a price for a special order. He has already prepared his tender, but has asked you to review it for him. He has pointed out to you that he wants to quote the minimum price as he believes this will lead to a more lucrative work in the future. So it is based on the condition under which the question is being asked that we would have to know the way we have to work this out generally. So it means that we would have to use what? The marginal costing principle again. So let's go. Mr. Smith tender. Materials. So there are 4 types of materials here. 4 types of materials here. But there are notes attached to them. So let's go to the notes and let's look at it. Other information. A, please stay with me carefully. As always, when it comes to relevant costing analysis, you must understand the scenario very well so that you know exactly what you're supposed to do. So let's see what we got. Material A. 1,000 kilograms of this material is in stock at a cost of $5 per kilogram. Stay with me carefully. As we say always, this is the historical cost. And fire, okay? We don't care about the historical cost. So that is an irrelevant cost. We're not going to consider that. But 1,000 is in stock. Go back up. Material A, we need 2,000. So if 1,000 is in stock, then we would have to buy the other 1,000. Are you getting it? We would have to buy the other 1,000. But let's continue to read. If the material is in stock, the next question we ask ourselves is it in constant use? If it is in constant use, if it is not in constant use, the next question we ask ourselves is, does it have an alternative use? So let's continue to read. Mr. Smith has no alternative use for his material and intends selling it for $2 per kilogram. Okay, so there is no alternative use, but he can sell these 1,000 units at $2 per kilogram. What does that mean? It means that if we should use the material for this particular project, it means he cannot sell it. So there is a lost revenue, and that lost revenue becomes the opportunity cost, and that becomes the relevant cost. Stay with me carefully. But let's continue to read. However, if he sold any, he would have to pay a fixed sum of $300 to cover delivery cost. Remember, he is going to use the material for this project, which means he will not sell it, which means he will not have to pay the fixed delivery cost. The current purchaser's price is $10 per unit. So how do we get a relevant cost in the context of this question? Remember, we need 2,000. So we have to buy the 1,000 that we have to buy. So note 1, that is material A. Slash in your currency sign, we will purchase 1,000 kilograms at $10 per kilogram. And I'll need some fastest hand here for us to get our answers coming in. And that is going to be 10,000, I guess. But the remaining 1,000, the additional 1,000, which is already in stock, 1,000 kilogram already in stock, we have to determine the relevant cost. Remember, they can sell it. So if we use it for this material, we won't get a sales revenue. So we'll bring in the lost revenue from the disposal. And that is, how much can he sell it? We are told $2 per kilogram. So that's 1,000 kilogram by $2 per kilogram. And that's going to be 2,000. So we won't get this revenue. Mr. Smith is not going to get this revenue. But you have to less the cost that he will not incur as a result of the sales. So we have to less the fixed delivery cost, 300, because he will not pay that. Are you getting it? He will not pay that. Hence, the material that is already in stock, its relevant cost becomes 1,700. So in principle, our material A's relevant cost is going to be 11,700. That is the relevant cost of the material A. Any questions, you raise your hand, we bring you up, or you put it in the chat for me. So that's our relevant cost. That's our relevant cost. So that is material A. And that is coming from note 1, 11,700. 11,700. So that is the issue relating to the material A. And that's how we determine the relevant cost. So get a concept well. We need 2,000. We already have 1,000 in stock, so we need to buy the 1,000. Now, what is in stock can be sold for $2 per kilogram. But if the entities sell it, they would have to incur a delivery cost of 300. So in actual sense, if they should sell the inventory, they will get 1,700. Now, since they are going to be using the inventory for this project, they won't get that 1,700, and hence it becomes what? The relevant cost. Technically, that is an opportunity cost for us in case you want a terminology, because they will not get it. So it's more or less like an opportunity cost. They would have to not sell it so that they can use the material for this particular project. So that is the idea about this material A. Let's go to material B. With material B, we need 1,000 kilograms at $15 per kilogram. Let's go read the notes. Stay with me carefully. It says that there is plenty of material B in stock and it costs $18 per kilogram. There is plenty. So a lot of them is in stock and it was bought at $18 per kilogram. Remember, the $18 per kilogram is the historical cost. Is the historical cost. Now, with historical cost, again, that is not relevant for us. So how much they bought those inventory at, it's not something that we are going to be concerned about. But we are told that the current price is $15 per kilogram. So if we are buying that same material now, $15 per kilogram, then the final information, the material is constantly used by Mr. Smith in his business. So remember, if material is in constant use, then the relevant cost becomes what? The current purchases cost or the replacement cost. So because it is in constant use, when we use it for this project, we would have to what? Replace it. When we use it for this project, we would have to replace it. So let's go back. We need 1,000 and the current purchases price is $15 per kilogram. So we go to the second note. And that's material B. Since material B is in constant use, the relevant cost shall be the current purchase cost. So that our relevant cost will look like this, and that's 1,000 kilograms at $15 per kilogram. That's going to be 15,000. So for material B, our relevant cost is 15,000. Sounds good? That is for material B, and that is the relevant cost of material B, 15,000. 15,000. Any questions? You raise your hand, we bring you up, or you put it in the chat for us. Let's go to material C. Material C, we need 500. But let's go see the information on material C. We are told that the total amount in stock of 500 kilogram was bought for $10,000 some time ago for another one-off contract that never happened. Again, how much they bought it for, we don't care. So that is not relevant to us. Sounds good? Because immediately you read a question, you have to know which figure you are to take care of, you are to consider, and which figure is not relevant for the analysis that you are making. I hope you are getting the idea. So that 10,000, we don't care. But remember, material C, we need 500. It means all the 500 is in stock. But let's see. Mr. Smith is considering selling it for 6,000 in total or using it as a substitute for another material constantly used in normal production. Okay, so there are two options here. Either he will sell it for 6,000 or use it as a substitute to produce another product, which is in constant production. Stay with me carefully. So it means the relevant cost now will be between the selling price and the alternative there. Listen carefully. If used in this later manner, that means if it is used as a substitute for another material, which is in constant use in the normal production, it will save $8,000 of the other material. Current purchase price is $40 per kilogram. So the question here is, what's the relevant cost? Now remember, there are only two options available for this product. So the current purchases price, no cry there, forget about it. Again, that's not relevant for us because the material is not in constant use. The 500 kilograms of material in question is not in constant use. So that one, it's not even our headache. I hope you're getting me. That one is not even a headache. But now there are two options here. Sell it for 6,000 or save yourself 8,000 by using it as an alternative for another material. If you are the production manager, you are Mr. Smith, which option will you go for? Do you sell 6,000 or you save yourself 8,000? Certainly, saving yourself 8,000 will be the best alternative. Are you getting the idea? Because you better save yourself 8,000 than to get 6,000. So with this one, the relevant cost is the opportunity cost of $8,000 being the cost saved on the alternative material, which is higher than the selling price of $6,000, which is higher than the selling price of $6,000. Does that make sense? That's our relevance cost. So material C, we're going to have 8,000. Note 3, 8,000 as the relevance cost. 8,000 as the relevance cost. Any questions? You raise your hand, we bring you up, or you put it in the chat for us. So that's the material C. So two options available: sell it for 6,000 or use it for another production. If you use it for the other production, then you don't have to pay 8,000 for that material that is in the other production. So do you sell to get 6,000 or you save yourself 8,000? You are better off saving yourself 8,000. Hence, you go with that option. Hence, you go with that option. Then material D. That's 50 liters. That's what we need for this order. Let's go read and see what's happening on material D. There are 100 liters of this material in stock. So we have a lot in stock than we need for this order actually. It is dangerous, and if not used in this contract, will have to be disposed of at a cost to Mr. Smith of $50 per liter. Stay with me carefully. The current purchase price is $12 per liter. Now, there is only two options available for this material, which is already in stock. Either we use it for this order or we have to dispose it of. Hence, the current purchase cost of $12 per liter is irrelevant. Now, if we use it for this order, what is going to happen then is that Mr. Smith will not have to pay the disposal cost. So this order is saving Mr. Smith the disposal cost of $50 per liter. And so that cost savings becomes the relevant cost, and that will reduce the current cost for the order. Does that make sense? Note 3, material. Sorry, note 4, material D. So the relevant cost is the disposal cost that Mr. Smith will save for not disposing the material as it is used for the current order. As it is used for the current order. So that is going to be coming in there for the period under review. And so disposal cost is going to be 50 liters at $50 per liter. And that's going to be 2,500. Be careful because this is a cost savings. Okay, so material D for 2,500 is a cost savings, so we'll deduct it because he will not incur that cost, so we'll deduct it. Sounds good. He will not incur this cost, so we will deduct it. That is the idea about that. Any questions, you raise your hand, we bring you up, or you put it in the chat for us. So that is the way we determine the relevant cost for the material D. That's the way we determine the relevant cost for the material D. Let's continue. So we are done with the materials. Now let's go to the labor. Labor is also divided into three categories. We have skilled labor, semi-skilled labor, and unskilled labor. So let's take them one after the other. Skilled labor, we need 1,000 hours. Let's go find out the information about the skilled labor. What are we told? Let's see what we are told. Mr. Smith only hires skilled labor when he needs it. Did you hear that? So it means these guys are not permanently employed. Okay, they are not permanently employed. So if they are not permanently employed, then the relevant cost will be what? The hourly rates that we pay them. And so we are told that $25 per hour is the current hourly rate. So for the skilled labor, we are going to be using the current hourly rate. And that is note 5. Skilled labor. As labor is not permanently employed. Remember, the reason we are writing this notes down is because the examiner said we should explain what we are doing. That's why we have to write these English down, do these calculations, because you have to explain what you are doing. So as labor is not permanently employed, the relevant cost is the hourly rate multiplied by is the hourly rate. So labor cost will be, how many hours do we need here? I think we need 1,000 hours. I think so. Yes, 1,000 hours. And we have to pay them $25 an hour. So that our relevant cost becomes 25,000. So that is note 5 for us here. So skilled labor. Note 5, 25,000. Skilled labor, note 5, 25,000. Next one. Semi-skilled labor. Semi-skilled labor, we have 2,000 hours, or we need 2,000 hours. Let's go read the information about semi-skilled labor. Mr. Smith has a workforce of 50 skilled laborers who are currently not fully utilized. Did you hear that? We need 2,000 of them semi-skilled. We are told that there are 50 who are not currently occupied generally, or they are not fully utilized. It means these people are permanently employed, so we don't have to think about them again. These people are permanently employed, so we don't have to think about them again. But let's continue to read. They are on annual contract, and the number of spare hours currently available for this project are 1,500. Any hours in excess of this would have to be paid for at time and a half. The normal hourly rate is $15 per hour. So what does that mean? We need 2,000 hours of the semi-skilled. 1,005, the 50 people who are not fully utilized, they can give us 1,500 hours. So it means our headache now will be what? Only 500 hours, the extra hours that we require. I hope you are getting the idea. Note 6, semi-skilled. The relevant cost is the extra hours required so I'm going to put it this way. Total hours required. We need 2,000. Labor hours available. Meaning that these guys are, having spare capacity. So there is a spare capacity. There's, let's say idle time. That's idle time. 1,500. We don't have to pay for that. So the excess hours we need is 500. It's 500 hours. Now stay with me carefully here. The way we pay this excess hours is time and a half. Time and a half. What does that mean? Simple. It means that the rate is going to be time and a half. That's all it means there. What is the meaning of time and a half? It means that we look at the rates that we pay plus half of the rates that we pay. Okay, so there are two ways we could present that generally in that particular case. And I'm going to show you the two ways. The one that you are comfortable with, then you can stay with it. Okay. So let me show you the two ways for addressing such scenarios. Time and a half. So you can do the calculation based on the hours, or you can do the calculation based on the rate. So let me explain that to you. If you are using the hours, time and a half will mean the time that we require, the extra hours, which is 500, plus half of the extra hours, because it says time and a half, which is going to be 250. And that will be a total hours of 750, so that you bring in the rate per hour, which is an amount of $15. You multiply it up so that the labor cost will be how much? 11,250. This is one way to arrive at the figure, time and a half. Time and a half. So you look at the labor hours that we need, that we have to pay for, then we add half of that labor hours to it, so that we now get a total labor hours of 750. Then we get our answer coming up. Alternatively, we could use the rate. The rate will be like this. We bring in the normal rate that we will pay people. So the normal hourly rate, which is the $15, time and a half. So we will add the premium that we have to pay them, because the half of that. So that is like an overtime premium that we are paying them. And that's going to be half of 15. 15 divided by 2 is 7.5. So that now the overtime rate or what we call the premium hourly rate, will now be $712.22.5. Then we can multiply that with the extra hours we need, which is the 500 hours, so that the labor cost will be, it should give us the same answer, 22.5 by 500, 11,250. So these are the two schools of thoughts of dealing with these issues. Now the examiner can say time and a quarter. If he says time and a quarter, then you do 1/4. He can say time and a third, then you do 1/3. He can say double the time, then you do ×2. I hope you are getting the idea. So whatever language the examiner uses, these are the two options available, and you can choose which one you are comfortable with in arriving at the labor hours. Sorry, the labor cost. So time and a third, 1/3. Time and a quarter, 1/4. Time and a half, 1/2. Double the time, you multiply it by 2. And you can decide to use the hours or you use the rate. Whichever you are comfortable with, you go for it. That is the relevant cost for our semi-skilled labor. Any questions? You raise your hand, we'll bring you up, or you put it in the chat for us. So semi-skilled labor. Note 6, 11,250. 11,250. So that is the relevant cost for our semi-skilled labor. Very sweet, simple, straight to the point. Then I think there is a third type of labor, that is unskilled labor. Unskilled labor. Now we need 500 hours of these people. 500 hours. Let's see how the additional information will guide us on what has to be done in the context of this question. Where is it? Unskilled labor. These are currently fully employed by Mr. Smith on jobs where they produce a contribution of $2 per unskilled labor hours. So fully employed, it means there is no idle time. Sounds good? Unlike the semi-skilled labor who were having idle time, hence we just focus on the extra hours. These guys are fully employed. There's no idle time available. Their current rate is $10 per hour, although extra could be hired at $20 an hour if necessary. So the question we ask ourselves is, what is the relevance cost here? What is the relevance cost here? Now, these guys are permanently employed, so the rate per hour is not relevant. So the $10 per hour here is not relevant. We won't going to consider that. So the question then is, should we use our own employees who are currently earning us $2 per unskilled labor hours, or we should go outside and hire people and pay them $20 an hour? Which one is cheaper? It'll be better for us to lose the $2, isn't it? So that we can use our current labor force to be able to do the work that has to be done in that particular case. But you got to be careful about what is going on. It says that these are currently fully employed by Mr. Smith on jobs where they produce a contribution of $2 per unskilled labor hour. So how many hours do we need? We need 500 hours. There is an opportunity cost here of $2 per hour. $2 per hour. Now, so if they have to, because they are fully employed, there is no spare capacity. I made an error. I'm going to take that again. Because they are fully employed, there is no spare capacity. So if they have to work on this order, we would have to pay them their basic wage, okay, because they would have to work overtime. So we have to pay them their basic wage because they are fully employed. There's no spare capacity available. So it means that the current rate per hour would have to be considered because they are fully employed. If they were not fully employed, then we wouldn't have taken care of the rate. So let me put down the grammar. There we go. So note 7. Note 7. Unskilled labor. Oops. These are fully employed by Mr. Smith and the relevant cost shall be the lower of lost contribution plus the rates per hour and the extra hiring rate per hour. So let's explain that. Because these guys are fully employed, let's look at their rates. Now, for the extra hours, we've been told it's $20 per hour already. That's on the high side. But if we used our own employees, So relevant cost of using current employees. If we move them from the current job, they will have to lose money. So loss contribution, and that is the $2 that we'll be losing plus their rate, hourly rate, which is the $10. So if you check it up, the total cost of using our labor is going to be $12. Okay. The relevant cost of using our labor is going to be $12. When we compare this to the extra hiring cost, that is $20. It will be cheaper to use our labor force. Okay, to use our labor force. So the relevant cost is $12 per hour, as it is cheaper to transfer current employees than to high extra hours at $20 per hour. So our labor cost for the unskilled labor will now be the $12 per hour multiplied by how much hours do we need? Just 500. 12.5 is 60. And so that's going to be 6,000 hours. That becomes the relevant cost of the unskilled labor. That becomes the relevant cost of the unskilled labor. So that is note 7. Unskilled labor. Note 7, 6,000. So that is the issue relating to that as well. Any questions, you raise your hand, we bring you up, or you throw it in the chat for me. Then we come to fixed overheads. Fixed overheads is 42,000. Let's go and read that. Sorry. You know, overheads are not supposed to be included, but we have to read to see, are they specific overheads? Because if they are specific overheads, it will be relevant. But if they are not specific overheads, then it will be irrelevant. So let's look at it. This is considered by Mr. Smith to be an accurate estimate of the hourly rate based on existing production. What the heck is that? This is considered by Mr. Smith to be an accurate estimate of the hourly rate based on his existing production. Now, that means this here, it's more or less like a general overheads. They are fixed overheads. They are not being incurred as a result of this particular project. If we are incurring them as a result of this particular project, then it will be good for us to include it. So the fixed overheads will not be relevant. We're not going to consider it in our workings because it's a general overheads. So we're not going to consider it. Okay, we're not going to consider it because it's an estimate based on existing production. It's not a specific phase overheads. So we don't going to consider that. Then cost of preparing the tender. Can you imagine? He's including cost of preparing the tender. Let's see. Mr. Smith time, 1,000. So he's putting money on his time. Let's see. Cost of preparing the tender. Mr. Smith has spent 10 hours working on this project at $100 per hour, which he believe is his charge out rate. Please listen to grammar. Has spent, not will spend. Has spent. So that is in the past. This is a sunk rate. We don't consider it. Do you see the idea here? He has already spent the time. So he's not going to do anything again. So whether we continue with this project or we don't do the project, he has already prepared a tender and he has already spent the time. So this is a sunk. It's not a cost. He has not even incurred any cost. It's a sunk information. It's in the past. We don't consider it. So his time that he has put $1,000 on, that's a sunk scenario. It's a sunk cost. So we don't consider it. Sounds good? We don't consider it. So it means that if you don't pay attention to the grammar that is stated there, that he has spent, not he expects to spend, then we would have considered it. But since he has spent, past tense, it's sunk. And these are the minor languages that can deceive you sometime in the exam hall. Then we look at the last one, other expenses, 500. Let's go see what we have for the other expenses. Other expenses include cost of travel and research spent by Mr. Smith on the project. 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 Again, it has already been spent, so that's a sunk cost. Not relevant to us. Not relevant to us. I hope we are getting the idea because it has been incurred already. Whether he continues with the project or he doesn't continue with the project, that ain't our issue. Then minimum profit. We are told that profit, Mr. Smith, minimum profit margin, which he believes is necessary to cover general day-to-day expenses of running the business. We don't care about minimum profit. Because remember, the question said, what should be the minimum tender price? So his profit should not be a concern to us here. So our minimum tender price would then be the addition of these costs here. So this becomes the minimum tender price. This becomes the minimum tender price. So let's see how much we got. 11,700, 15,000, 8,000, minus 2,500, plus 25,000, plus 11,250, plus 6,000. And that gives us 74,450. So this is the minimum tender price that Mr. Smith can charge for the project. Remember, the question said minimum. Okay, the question didn't say how much should he charge. So this is the minimum that he can charge. Assuming we are supposed to really look at his amount that he's supposed to charge, then we could have done bring in his profit of 5% on total cost. That is a markup, and build that into the system. But if we take out the profit that he is going to make, this is the minimum that he can charge. And that is the answer to the question on Mr. Smith. So that is what you're supposed to do in the context of this particular question. And that's about short-term decision, relevant cost analysis. Relevant cost analysis. Any questions, you raise your hand and we bring you up, or you throw it in the chat for us. I'm seeing some chats coming up on YouTube. Let's see if I can look at them here. Oops. I don't know, my YouTube is not opening on my device. I think it's here now. Okay. Deborah Boatin said, hello. Hi, Deborah. Mohammed Suarez said, thank you for clearing this point for me. I was wondering as to how to treat material C. Mohammed from Celerion. Okay, that's fine. Genesis said, hey, thanks so much for the knowledge provided. Always a pleasure. Then Mohammed Alaran said, please, how can we get the question you are using? You can just Google. It's a question that is available on YouTube. Sorry, on if anything. On okay, maybe you can send us a message on WhatsApp. We can see if we can send it or share it with you. So let me bring back my screen and let's go to our second question. That's the marginal and absorption costing. And the marginal and absorption costing, it's in our question, management accounting introductory documents. And I think that's the final question, smooth sailing, question 10. I think that was what was given as an assignment to you guys. So let's see what we can do in relation to this one. Now, the issue generally about marginal costing and absorption costing has been how most of you are messing up with determination of the cost per unit and also dealing with over and under absorption. That has been the headache of many of you. So let's see how we can use this question as a guinea pig to, sort of close the gap in relation to this question. So let's see what we got. Our question is Smooth Sailing Limited. Oops. So let's see the requirements. We are supposed to use marginal costing principles, prepare a statement of profit or loss for the 3 month to September 20X9, and then using absorption costing, prepare a statement of profit or loss for the 3 months to September 2019. So this is a 20-mark question that we have here. Let's see what we can do. So number one, we're going to find out and do some workings quickly as we start the journey. Okay, so stay with me carefully. Let's do some workings. As always, it is important to, set out the workings for the question. So the first workings you want to look at is, the cost cut, so that you can calculate the cost per unit for us. So cost per unit. And we will present it in both the marginal costing and absorption costing school of thought. So marginal costing and then absorption costing school of thought. We are in Ghana here, so let's bring up the miserable currency. Ghana cedi. Now remember, in marginal costing, we are interested in what? Only the variable factory cost. Please note the cost per unit we are calculating here is the production cost per unit. Because some of you screw it up and we're calculating the total cost per unit, but it is the production or factory cost per unit. That's what we are interested in. The production or the factory cost per unit. So in marginal costing, we are going to be dealing with the variable production cost. Then in the absorption costing, we will deal with what? The total production cost. So stay with me carefully as we try to bring up these items. So let's go back up. Smooth Sailing makes and sells a single product called VIs. VIs. The following information relates to the costs, volumes, and selling cost, volume, and price for the third quarter just ended, 30th September 2019. So we've seen the production, we've seen the sales coming in for the period under review, and we've seen the selling price per unit. We'll come to that later. But the unit cost, this is what we are excited about. This is what we are excited about. So let's bring up the unit cost. Stay with me carefully. We are interested in production unit cost. So it means we are going to exclude the fourth variable cost, which is the variable sales overhead. Please stay with me carefully. We're going to exclude the variable sales overheads because that is a non-production cost. That is a non-production cost. So let's go. Direct material, direct labor, variable production overheads. So direct material, direct labor, then variable production overheads. So let's bring in the costs respectively. What do we have? 14, 4, 2. 14, 4, 2. And that same thing will be in absorption costing, 14, 4, 2. And that is the variable or marginal production cost. That is marginal or variable production cost. Or factory cost. So how much do we have? 18 plus this, that is going to be 20 here. There's going to be 20 here. But remember, in absorption costing, it's in accordance with IAS 2. So we have to use full factory cost. Sounds good? But in marginal costing, you have to use only the variable cost. So it's more or less like in the marginal costing, we are done. Because in marginal costing, to determine factory cost, you use only the variable factory cost. But let's continue to read. Fixed cost for the month. Production overheads. Okay, we are interested in that. That's 40,000. So let's go read additional information because the examiner has given us a breakdown of what the heck that information really is for the company. So let's go read it. Fixed production overheads are budgeted to be 40,000 per month for a budgeted production unit of 20,000 units. All right. So what do we have to do? It means we have to calculate the overhead absorption rate per unit so that will help us to then determine the fixed overheads that will be added. So I could bring that to working stew, the overhead absorption rate. And that is going to be the total overheads divided by the production units. So it means in this question, we are absorbing the overheads using the production units. So the total overheads in this question, we are told every month is 40,000. And by that, we are producing 20,000 units. Okay, 20,000 units. So it means that our overhead absorption rate per unit is going to be 2 Ghana cedi per unit. 2 Ghana cedi per unit. Hence, that will come here as fixed overheads. That's 2 here. So that now our production cost for the absorption costing, which is at full factory cost, is going to be what? 22. Sounds good? That's the idea about that. Because in the absorption costing, we use full factory cost as per IAS 2. As per IAS 2. So this is the starting point. This is where many screw it up. And if you screw it up here, it means you're likely to screw it up later as well, because it will then affect the various workings that you are going to be doing in the profit statement of the company. So this is what we have. So based on this, any questions, you put it in the chat or you raise your hand, we'll bring you up. So based on this, we can then go in there and answer the question. So the A aspect of the question, we go to the profit statement that they say we should prepare. Statement of profit or loss. For the year, sorry, for the period ended 30th September 2019. And we're going to be starting with the A aspect, and we are using the marginal costing. Again, remember, in marginal costing, we are interested first in the factory margin. Then we can come to contribution. Then we can less all fixed cost to get our net profit. You know that, right? So that is the same thing we are applying here. Now, we are working for 3 months. So it is July, August, and September. So it depends, but I'm going to see if I can have the 3 coming in one schedule. I don't know. I don't want to squeeze things also up. Okay, we're gonna work 3 zeros up possibly. I don't know. Yeah, we can work 3 zeros up. The figures are absolute figures, so we can work 3 zeros up so that I can bring them in the same place here. So let me rule my lines. Something like this. I'm still not satisfied with this. One, 2, 3. This one is too big. This is also too small. Give me a moment. I'll just find a sweet spot and then we go. This is okay. Maybe this is okay. Just don't want to come into the margin, but it's like I'm going to extend and come into the margin a little. Then under each of them, we're going to try to have, under each of them, we're going to try to have 2 cash column. So let me zoom back down. Like this. Like that. Like that. Okay. So we're going to try to have 2 cash columns under each of them. I know some are bigger than others, but we're going to just present that way. So July, August, and then September. The reason I need 2 cash columns under each of them, it's because of the way we have to present. Because we could work in 1 cash column, but it will be a little bit scanty. So we will tell the examiner we want to work 3 zeros up. The reason we can work 3 zeros up also is because the figures are in absolute terms. So working 3 zeros up will help us even to squeeze the space up a little bit. So that is the period we have. So let's start. As always, we're going to start with the sales. So let's bring in our sales respectively. What is the information about the sales? We are told that the sales times the selling price has been given. So we can do a workings for that so that we can bring the absolutes up. So let's copy this. These are the sales units. And we're going to do a workings for that. So let's go back to workings 3. Calculating the sales. There we go. So we can multiply up. It's 35 throughout. 35. So let's multiply up. Remember, we're going to work 3 zeros in brackets. So we can just punch without the 3 zeros. 10 by 35 is 350. 15 will be 15 by 35. 525. 18 by 35 will be 630. So that is coming from workings 3. We bring the figures up into the second column. 350. 525. 630. So that is our selling price. Then what do? We less marginal cost. Now, remember, I told you that there are 2 schools of thought. Either you just work with the sales figure throughout so that you don't have to bring in any issue about opening and closing. Okay, so that you don't bring any issue about opening and closing. So I'm going to do the marginal costing just with the sales figures. Just with the sales figures. Then in the absorption costing, we'll bring in the opening and closing so that you see the 2 alternatives. I can't do the 2 methods or the 2 approaches under the 2 methods. I mean, it will take us forever. So in the marginal costing, we were just going to work around using just the sales. Using just the sales. The reason is that if you bring in the production unit, come and bring opening and closing stock, the net effect is going to be the same. So we can just work with the sales unit. So we will less the marginal cost, which we could work for based on the sales unit we have here. So that'll be workings for marginal cost, marginal factory cost. And we did a calculation for that from workings 1, it's $20. Oh, sorry, 20 Ghana cedi. So we won't do times 35. We are doing times 20. Times 20. Like I said, I'm using just the sales unit. So we're not going to do any opening or closing stock. We are not going to do any opening or closing stock. So let's multiply up. And that gives us the marginal factory cost. And it helps you in the exam hall to save time. So this is going to be 200 generally. And then we're going to be having 300 here, then 360 here. So that is our marginal cost from workings 4, 200, um, 300, and then 360, 360. So to be able to be specific, let's rewrite this as lesson of marginal factory cost and that's coming in from workings 4. So we less this. Now, when you less the marginal factory cost from the sales figure, you get what we call factory margin. Okay. Factory margin. So what do we have? This will be 150. This will be 225. And then this will be 630 by 360. That'll be 270. But remember, you are not done because in the question, we were told that there is variable sales overheads. So that is a non-production variable cost. So we're going to less the variable sales overheads. And we may have to do workings for that in workings 5. So workings 5, the variable sales overheads. Again, we are working using the sales. And even if we were not working using the sales overheads will always based on the units we are selling. Okay, will always based on the units that we are selling. So what do we have? The variable sales is 2 Ghana cedi. So I'm going to work with 2 Ghana cedi here. 2, 2. So what do we have? We're going to have 20 here. We're going to have 30 here. 18 by 2 is 36. Am I right? Yep. So that is workings 5, 20, 30, 36. 20, 30, 36. So that once you learn, now assuming there was no variable sales overheads or variable non-production overheads, then the factory margin would have been the same as the contribution. Do you understand the treatment? So we now have contribution here. So 150 minus 20 will be 130. This is going to be 190, 195, I guess. Let's confirm that. 225 minus 30. Yeah. And then this is 36. Let me write that well. So 270 minus 36. And that is 234. That is 234. So that is the issue in relation to that. 234. So this is our contribution. Sounds good? That's our contribution. Any questions, you raise your hand, we bring you up, or you put it in the chat. Now, remember when you are dealing with marginal costing, absorption costing, marginal costing, you don't deal with anything like over or under absorption of overheads. So no P on that. Then we're going to less fixed cost. We may have to do workings for that. So that may go to working 6. So we bring it in. What is the fixed cost? We have the fixed monthly production overheads of 40,000. You don't need any miracle for that. So probably you don't have to do any workings for that. Maybe we don't need any workings. So let's bring in the production overheads. How much is there? 40 every month. So that's going to be fixed irrespective of the unit you are producing. Okay, so maybe let me put this in the first column so that the total will come to the second column. So 40, so that it doesn't appear like we are wasting the first column. Then we have administration overheads. That's 15. That's fixed, so we will incur it anyway. So admin overheads, 15, 15, 15. Then next one, selling and distribution, 25. All these are fixed, so we just bring them up. Selling and distribution overhead, 25, 25, 25. So we can add these up and take it to the next column and less it from the contribution so that we can now have our amounts for the period. So let's see. What do we have? 40, 15, 25. That's 80 throughout. So you now less the fixed cost from the contribution, and that will give you the net profit for the period. That gives you the net profit. So 130 minus 80, that's 50. 195 minus 80, that's 115. And then 234 minus 80, that's 154. This is the answer to the marginal costing question. This is the answer to the marginal costing question. So like I said, this approach is very smooth. Okay, you're not doing anything like opening, closing, da 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 da. No, you just go straight. You just go straight. And then you go away in that regard. It becomes more easier, crapple, if you're using this approach. Like you are doing your workings based on just the, how do we call it? The production, the sales unit. You're just using the sales unit. So let's get a B aspect, the same issue, but this time around, we're going to use absorption costing. Oh, I should have copied the original table. Okay, I'm going to copy the entire thing anyways. So that I'll clean the individual figures so I don't have to spend another time trying to draw and get precision on my pencil. Let's see, I'm going to try to duplicate this guy. So let's go to the B aspect. So the B aspect, the same scenario, but this time around, we're going to use absorption costing. You know what? Under the absorption cost, I'm still going to use the sales approach here. Then we would do just for opening and closing, so you see how it goes. Okay, so stay with me carefully. So in the absorption costing, again, I'm still working using just the sales unit. I'm emphasizing on this because it's an assumption we are doing our workings with. So if you are working with just the sales unit, but if we are in absorption costing, remember, if you're in absorption costing, then over and under absorption of overheads must be something that we would be interested in and be looking out for. So stay with me carefully here. So I'm going to try to, clean everything because you're going to virtually be cleaning everything here. I want to ensure that I don't go outside. Yeah, there are some things I'm not supposed to clean them, but I'm going to clean them anyways so that we can work. The sales will be the same, so no need to clean that. I'm going to try to reconnect my lines up. Undo. Okay, so let's go. Now, in absorption costing, we less what? We less cost of sales. We're going to less cost of sales. We're going to less cost of sales. So let's bring it up and let's see what exactly we're going to be having in that period. So less cost of sales. So technically, this is going to be like less in the production cost. So we're going to do workings for this, and that could be workings, whatever. Our last workings was 5, so probably this will be 6. So let's go. Remember, we had the cost per unit based on the factory overheads to be 22. And like I said, we're going to be working using just the sales unit. So it will be 22 at the sales unit. So let's go to working 6. Calculating the cost of sales. Or if you want, production cost. I'm going to try to shift this guy a little bit above. Then I'll bring in my sales unit again. But this time around, we're going to multiply by 22. Okay, 22. Because that is our factory cost. So it's not selling price per unit. This is variable cost per unit. This is also not sales price per unit. It's actually supposed to be the marginal cost per unit. I forgot to change them when I was using the same thing. So this is our factory cost per unit. Per unit, which we did workings for in workings 1. Sounds good. The marginal cost per unit, we did workings for it also in workings 1, so that you know where we are picking the issues from. So let's multiply up. What do we have? That should be 22, 220 here. Then we're going to be having an amount of what? 15 by 22, 330. Then we will have an amount of 22 by 18. That'll be 396. 396. So you see that we are working around the sales. So 220, 330, 396. We bring it up. 220, 330. And then 396. So let's subtract it. And so when you subtract, it gives you gross profits. Gross profits. So what do we have? Let's punch it out. 350 by 220. That's 130. 525 by 330. That's 195. 630 by 396. We are deducting, okay? Even though I'm using the word by. Yeah, so that's our gross profit. Again, if you are working around the sales unit, you realize that you don't think about what is the opening stock, what is the closing stock. You're not thinking about that. You're not thinking about that. Now, immediately we get the gross profit, it'll be prudent for us to go check whether overhead is over-absorbed or under-absorbed. Sounds good? It's overhead being over-absorbed or under-absorbed. So let's go check. And we're going to do workings for that. And that'll be working 7. over or under absorption of overheads. Now, this is another part that, people were screwing it up. So we're going to have July, August, September, slash in our currency sign. Remember the overhead cost that we are supposed to incur every month. Okay, overhead incurred as per the budget of the company was given in the question to be what? 40,000. The fixed production overheads, 40,000. Under and over absorption is done only for the production overheads. So the fixed overhead we are supposed to incur is 40,000 throughout. 40,000. So we have to compare that with the fixed overheads that we absorbed. Overhead absorbed. Now, what is the overhead absorbed? We have to do calculation for that. Overhead absorbed. Let me just duplicate this. And then bring it up there. We bring in the overhead absorption rate we calculated from workings. What? Workings 2, we calculate the overhead absorption rate to be $2 per unit. Then we'll bring in the production units, because remember, if you remember what we did, we absorbed the overheads by multiplying the rates by the actual production units. So actual units produced, and that is going back to the question, 15, 16, 12. 15, 16, 12. You're working 3 zeros in brackets. I forgot we should have worked 3 zeros up since we are doing the same thing, so that there is some unism here. So 40 throughout. So let's multiply up. This gives us the overhead absorbed. 15 by 2, 30, 32, 24. So the overhead absorbed from workings 8 is 30, 32, and 24. So what's going on here? What's going on? We are supposed to incur overhead of 40,000. But based on the calculation that we have done, this is the overheads we absorbed. It means we have under absorbed the overheads in all cases. We have charged less than we are supposed to have charged. So we are supposed to charge 40,000. But based on the calculation, we charge 30, 32, and 24. So that is under absorption of overheads. Coincidentally, it's going to be, all will be under absorption of overhead. So it's going to be 10 here, 8 here, and 16 here. And when overhead is under absorbed, what do? We deduct it from the gross profit. So that is working 7, and we bring in under absorption of overheads. Do you understand? Raise your hand, we bring you up. Or put it in the chat. Working 7. We're going to be deducting that respectively. 10, 8, 16. 10, 8, 16. So we deduct that because overhead is under absorbed. Then we go back and bring in the non-production overheads. So we can decide to get the net figure here if we want to. That's 120. 195 minus 8. 187. 234 minus 16. That's 218. So we can now less non-production overheads. We less non-production overheads. And the non-production overheads, there is a variable sales overheads, which we did workings for. So we're going to bring it up. Let's go pick it up from workings. The variable sales overheads from workings 5. Okay, 20, 30, 36. Workings 5. 20, 30, 36. Okay, because the same issue will come here. 20, 30, 36. So we're going to utilize it on the column. Then there are other non-production overheads which are fixed. So we bring in the admin overheads 15, selling and distribution overheads 25. Admin overheads 15, 15, 15, selling and distribution 25, 25, 25. So we add it up. Let's see what we get respectively. That's 40, that's 60. 60. No, I'm not sure it will be the same. This will be 70. And this will be 76. So you now subtract the non-production overheads from the net figure, and that gives you the net profit. This gives you the net profit. So that's 120. Okay, that's 60. I could do that. Okay, I could do all that also. 117. And then 218, 76, 142. So this is also the answer to the question using absorption costing. Okay, remember in both cases, we didn't do any, opening stock, closing stock, and all that. That's the idea about that. So you realize that in this case, you use less time than you're supposed to use because you're not bringing anything like opening stock, closing stock, and all that in your workings flow. Any questions about that? I believe everybody should stay with this. I don't know though. But let me just illustrate to you. If we were using the opening stock and closing stock story, like how it's going to look like, those kind of things. Okay. I'm going to do probably just July and August, just for illustration purposes. Oh, thought I had copied. So let me go and recopy this thing so that I'll illustrate just one to you. If there was opening and closing, how it will look like. Okay, so the same approach, but we're going to build in opening and closing. And so let's clean our things. Over and under absorption and all that will be the same thing there. I don't think a lot will change at the bottom. So I'm going to leave that a little bit open for now. The opening and closing will affect up to the gross profit. Not affect the figure, but affect the presentation up to the gross profit. So our sales is the same. So we're going to say less cost of sales. Stay with me carefully. So we're going to bring opening stock. Now remember, in July, there is no opening stock. So that's going to be dash. That's going to be dash. Then we bring in the production cost. We've already done production cost for July. That was the workings we did here for that period. Sorry, we would have to do workings for that. Let me bring it here. Production cost. So we have to go and pick the production units. Okay, which I have picked earlier. Let me go pick it up from here. So this is sales. Okay, I thought I had picked. So let's go pick the production units, because we need the production cost. The figure I wanted to pick earlier was based on the sales unit. So let's calculate the production cost. So cost per unit. That was from workings 1. We did the factory cost per unit from workings 1, if you remember. That was 22. Okay. So you bring that up. 22, 22, 22. So you multiply it, and that gives us the production cost. So 15 by 22, that's 330. 16 by 22, that's 352. And then 12 by 22, that's 264. Sounds good. So this is what we are going to be bringing here. 330, 352, 264. 330. I'm going to put that in the first column. 352. And then 364. So that's the production cost. It's going to run through for them. Then we would then less the closing stock. So you less closing stock. And you have to do workings for that also. Remember, closing stock will be valued at what? Full factory cost. So what will be the closing stock? Let's go quickly. We know the sales, we know the production. So we're going to be valuing the closing stock respectively for them. But I'm going to cut this and bring it up. But please stay with me for this one here, because the closing stock will be a little bit different for them. Now, for July, we don't need any miracle for July. So the closing stock for July will be the difference between what we produce and what we sell. So July closing stock is going to be 5,000. Agreed? 5,000. But August closing stock will not be the same. So for August, you would have to work it out. Stay with me carefully. So for the August, the closing stock for July becomes opening for August. So we were going to bring in the opening stock. And that is going to be 5,000. Then you add the production for the August, which is 16,000. So it becomes 21,000. Then you can less the units that we sold, which is 15,000. So that the closing stock for August becomes what? 6,000, I guess. Does that make sense? So stay with me carefully on that. So in August, because the opening stock for July becomes, sorry, the closing stock for August becomes opening for, closing stock for July, sorry, becomes opening for August. So it means closing stock calculation in August will be different thing. If we go to September, using the same school of thought, the closing stock for August becomes opening for September. So opening stock in September is going to be 6,000. Then you add production in September, which is 12,000. Then it gives us 18,000. Then you less the sales units. Sales for September is also 18,000. So it tells us that in September, there is no closing stock. Does that make sense? In September, there is no closing stock. So that is how we get a closing stock units. But we need to value them, isn't it? So this closing stock in August, in July, will be valued at the factory cost of 22 Ghana cedis. So 5,000 by 22, 5 by 22, what do we have? That's 110. So the closing stock for July is going to be 110. So you less that. That 110 will go to August as the opening. Okay. So that the closing stock for September will also be the 6,000 multiplied by the 22. And that gives you 6 by 22. That's 132. So in August, closing stock is 132. And that closing stock 132 becomes the opening for September 132. But remember, in September, we have no closing stock. I hope that makes sense. So now we can get our cost of sales. So our cost of sales will now be 330 minus 110, and that is 220. Then the next one will be 110 plus 352 minus 132. That's 330. Then for September, 132 plus 364. That is 496. So you can now less the figure from it respectively to give you gross profit. So gross profit will be brought in. So 350 minus 220, and that will be the same thing you got here, 130. The second one was 195. But the third one, 360, 630 minus 496, that's 134. Why is the third year having a different answer? Did we mess up something? Give me a moment. Oh, sorry, the production cost is 264, not 364 here. It's 264, not 364, because you're supposed to have the same answer. So this becomes 396, so that it will give us the same gross profit. Of 234. Do you understand? So the choice is yours. Then certainly you bring your over or under absorption of overheads, then you will get the same answer. So the choice is yours, over or under, which we did. We got 10, 8, and 16 throughout. 10, 8, and 16. The rest of the things will follow and you get the same answer. That is your it was under absorption of overheads. Let me use a different ink, under absorption. Then it follows through. So that's how we would work if we want to build in the opening and closing. So it means you need to do these extra workings. So the choice is yours. Like I said, it's about presentation. It's about presentation. So you would decide which one are you comfortable with. Would you be comfortable just working with the sales like we have done? Okay, will you be comfortable just working with the sales like we have done? Or you go through the hurdles of bringing in opening and closing and ensuring that you don't mess up the closing stock in the subsequent periods. Ensuring that you don't mess up the closing stock in the subsequent period. So these are the two ways that we can present ourselves when it comes to dealing with this particular question. Any question? That is the issue about that. And that is how we deal with marginal costing and absorption costing. So like I said, there are two options. You choose which one you are comfortable with from today. Okay, you have to choose that from today. If I see absorption costing, if I see marginal costing, I'm going to work using just sales. That's your swag. Or you can say that from today, I'm going to work using opening and closing. Still going to be the same thing. Remember, it's not about time really. I think the first approach using only the sales will save you time, but it is also about what you understand. So maybe somebody is comfortable with the opening and closing, fine, even though it will require more work on your behalf, on your part. And that is the issue about that. So that's it about it. And that's what you were supposed to look out for in that case. Say, what of reconciliation of profit? Yeah, you could do that to find out why the profits are not the same. Could put that up like this. We could put up the periods. Okay, it's not possible for me to pick up anything. So July, August, September. We're slashing our currency sign. Bring it up. Please, will you earn full mark if you choose any method? Yes. You are not under obligation to use any specific method. It's about which one you are comfortable with and which one you can present with. So, what do we start with? Maybe we can start with the absorption costing, profit, or anyone we can start with, because the difference that is going to be coming, it's because of over and under absorption of overheads. So usually, like I say always, this thing, you don't have to really have any miracle about it. So we can bring in the marginal costing profit. So what's our marginal costing profit from the A aspect? 50,115,154. Oops. And then the absorption costing profit is 60,117,142. So absorption costing. 60, 117. And then 142. So what is going on here? There was under absorption of overheads in either case. Under absorption. So in the A aspect of the question, there was an under absorption of overheads of what was it? Was that 10? Yeah, that was 10. So you bring it up here, 10. So that under absorption adding to that marginal costing will give you that profit there. But in the case of August, there was an amount of 8 and 16 for the other amount, 8 and 16. Now, so this is where from the subsequent year, the reconciliation nature is going to take a different format. What do we mean by that? Because like we said earlier, there are two reasons why there will be differences in the profit. The first one is the fact that we're going to have the over or under absorption of overheads. The second thing has to do with the valuation of the inventories. So if you look at it, under marginal costing, we are valuing inventory from Workings 1. Under marginal costing, we are valuing inventory at 20. But in the absorption costing, you are valuing inventory at 22. So you realize that there is an extra 2 that is coming in either case. So if you come to August, what was August? August had a closing stock of 22. So at a price of 22. Now, assuming that was valued at 20, that would have given us 120. In that regard. So by using the marginal and absorption costing method, that closing stock was valued in excess of about 12 in your presentation. Okay, in excess of about 12. In excess of about 12. So the question you then ask yourself is, how do you present your way out? Now, there are two ways we can go with this approach, because you realize that here, if you bring up the under absorption of overheads, you're going to screw yourself up because you're not going to get the balancing figure that you're supposed to get under each of the cases, because your absorption costing 60, 117, and then 142. So in the context of this question, how then do we reconcile? Like we said, we have to bring in the difference in the inventories to find out if it is possible for us to do a reconciliation. So the difference in the inventory valuation, let's go here. Okay, let me do the workings here. Inventory valuation. Let me pick this up and bring it up. Let's see. So under marginal costing, how will the closing stock be valued? Under absorption costing, what will be the closing stock will be valued? So under marginal costing, under absorption costing, we are valuing closing stock at 110 and 130 here. Under absorption costing, we would have valued it at 110, 132, sorry. Now there is no closing stock here, so that is not going to come in as a story. And the marginal costing will value the same thing at 20. So that's going to be 120 here. and then 5 by 20. That's going to be 100 here. So marginal costing, there was no closing stock in this case. So if you look at the movement in the inventory, you're going to have 10 here because you realize that the inventory is, sorry, let me pick that again because I think I'm messing it up. This is 110 here. This should be 100, sorry, because the margin, the absorption costing cost will be more. Okay, so this will be 100, so this will be 10 here. Then August, let me pick August again. August will rather be the 120, so that this will be 12 here. This will be 12. So if we look at movement in inventory, we realize that due to the methods that we use, inventory is being valued more, and that is always the case. Inventory is being valued more in the absorption costing than in the marginal costing. And these are the difference 10 and 12. 10 and 12. Now, if you say you bring the inventory difference here in the context of this particular question, you will realize that it will still not be able to reach the reconciliation. So in the context of this question, it means that there is more to what is happening here. Because if we bring in the movement in the inventory, you realize that we are going to go in and not get the profits to reconcile in either case. In either case. So this question, it's not structured in such a way that we can simply reconcile the profits. That is why you realize that it wasn't even part of the requirements. So it depends on the structure of the question. That's why I brought it up to you. It depends on the structure of the question. So there are certain questions, they are structured in such a manner that even if we finish with the calculation, we cannot reconcile the profit because it won't work. Because the structure of the question is not tailored to make the profit reconciliation really easy. Because if you realize September, there is no closing stock, right? But there was an opening stock in September. So it would then make the reconciliation of the profit not to be reliable in that particular case. Oh, okay. That was not part of the requirement. So Rose, so we will just ignore it in the context of this question. So sometimes the structure of the question will not permit us to do the reconciliation. Sometimes the structure of the question will not permit us to reconcile. So that is the issue about that. And that's it. I hope that is okay now. Okay. So that's it about it. And that's all about what we want to discuss today, dealing with the short-term decision, relevant costing, and also marginal and absorption costing. And I'm going to wrap up here. And I don't know, when again do we have? I think next week we have another session. Yeah, next week we have another session, standard costing and variance analysis. I'm going to do standard costing and variance analysis next week, meaning it's a full class I'm going to be teaching next week, God willing. So I'm going to do the same thing that we have there next week. So what we have on the timetable, I will be doing it next week in that regard. What do we have? What does it say? Linac question. Do we have any question called Linac? Which question was that? Did I give any assignments called Linac? So I don't remember giving an assignment called Linac. What's that under, and where is that question at? Really? I think I remember there's a question like that Linac in the question kits under activity-based costing. I think so. Let me see. Lenak. Oh, that question would take more time than I have available on my clock. So maybe because I didn't receive anything in relation to that, so I didn't even factor that in our presentation today. But it will take me more time than we have available on our clock, and I wouldn't want to rush it over. So maybe next week we could do that at the beginning before we jump into the variance analysis. Okay, so let's do that next week, God willing. We can use the first 20 minutes next week to do it. Maybe 20, 30 minutes, because I want to take time on the activity-based costing as well. So next week we can do that before we then jump to the variance analysis, which is going to be a new thing we're going to be doing. So we'll do it next week. All right. Okay, so that's it about that. Have a great week. Make sure you study, and I'll see you on Wednesday for investment appraisal continuation. I think Wednesday we have a performance evaluation test, right? And I'm also saying, no, we have a performance evaluation test. I remember we have performance evaluation test. So Wednesday, I'll see you people, and we'll continue with our discussion. Please make sure you study. We are in week 8 now, technically like 5 more weeks to go. 5. Just 5. So that's it about that.